So, warranties are a type of contingent liability that we have, and most of you are probably familiar with what a warranty is. So, when you go purchase a new car, it typically comes with a standard manufacturer's warranty, right? And that means if something is defective about the car, something that is their fault, they will fix it for you, and they will pay to have that fixed. So, typically when you see a warranty, it's because these are probable and reasonably estimable already. They already know that a certain number, a certain amount of their products are going to have some kind of defect with them. They're not trying for that. They're trying for, 100% no defects, right? But it does happen, and they know it's going to happen. And those costs are typically pretty easy to estimate. They arrive at the estimates for these warranty costs kind of the same way we arrive at the estimate for the allowance for bad debt, right? You're going to use your past experiences with that product. You're going to use some industry standards, statistics from the industry, benchmarking from the industry, benchmarking against other competitors in your market. There may be government legislation or government, there may be laws that say you have to offer this kind of warranty, this particular warranty when you sell a type of product. And there are other business conditions that they take into consideration as well. So what we're going to talk about in this chapter is, though, how we record those warranties. And I just want to tell you, we really do record these in a very similar fashion to the way that we recorded those allowance for doubtful accounts. Okay, we're going to make an estimate based on the number of sales that we have, and that estimate is going to become our expense. And instead of recording this to like an allowance account, we're just going to record it directly to the liability. Okay, we're liable. We're obligated to pay these. This is an obligation for us at some point in the future. Okay, so looking at this example, we're going to assume that warranty costs for Dell are estimated to be 3% of their sales. Their December 2024 sales are 1.5 million. So they're going to take that 1.5 million, multiply that times 0.03 or 3%, and then record the expected future warranty costs. That estimate, that $45,000, now becomes your expense and your liability. Okay, it's an expense because we're recognizing that there was a cost to selling these products. Okay, it's a liability because we haven't actually paid out of our pocket. We haven't actually paid cash for these yet. So here you can see we're going to increase the warranty expense, which decreases net income and decreased retained earnings. And we're going to increase the warranty liability. So this warranty liability account, think of it kind of like the allowance for doubtful accounts account. It is kind of a piggy bank for us. We are taking this amount of money and we are allowing for us to recognize that as an expense. Okay. So let's say that in January 2025, we had customers make warranty claims totaling $12,000. Okay, what we're going to do is we're going to reduce that warranty liability, that piggy bank account, by that $12,000, and we're going to reduce our cash by $12,000. Okay, because we're actually going to have to pay to have these defects fixed. Okay, so notice we really are just reducing that warranty liability the same way that we reduce the allowance for uncollectible accounts. Okay, it's just simply because there's not a contra expense account to take the money from. So we're just going to take it directly from that warranty liability account. This is the way you would typically see it presented in your balance sheet. You would have a beginning balance in your warranty liability, less any actual payments you made right here. And that's going to give you a current balance in your warranty liability account. So next thing we're going to talk about is long-term liabilities. There are several different types. In this class, we're going to focus on bonds. Okay, and bonds are just a debt instrument that the company issues to kind of borrow money. We talked about these in Chapter 8 when we talked about investments, right? This was a form of debt investment. We could purchase bonds in another company. Well, we're going to talk about them here in Chapter 9 from the perspective of us issuing or selling those bonds. Okay, when we issue the bonds, we make a promise to pay the investor back for the principal or the face amount. That's how much we say the bond is worth. So if it's a $100,000 bond, the principal is $100,000. Okay, and we're also going to pay them interest payments over the life of the bond. Okay, typically when we're talking about bonds, we're going to pay those twice a year or semi-annually. So when we report a bond issuance, This is like a Chapter 3 original journal entry. We get cash, but we also create a liability. Okay, so when we issue those bonds, let's say we issue $100,000 of bonds at 7% interest for $100,000. Okay, we're issuing these at face amount. The principal is $100,000, but we're going to have to pay 7% interest a year over the life of this bond to the bondholder. Okay, so the first step is to record the issuance of the bond, and we're just going to take and increase our cash asset account by $100,000 because we got $100,000 in cash. We're also going to increase our liability account, our bonds payable liability, for $100,000 because we're recognizing the fact that we owe somebody $100,000 at the end of this. Okay. So the next part's somewhat more tricky, but it's not something we haven't already done. This is kind of a Chapter 4 adjusting type entry, right? We are now having to recognize that we have to pay this expense every 6 months, and this expense just happens to be the interest that we owe them, that cost of borrowing that money. So when you see the term stated interest rate, it simply means what was the rate specified or stated on the face of the bond. In our case, it was 7%, right? So we're going to use our ART formula. And if you remember back in video 1, I said there's going to be something slightly different about it. Here you can see it's multiplied times 1/2. You could just as easily multiply that times 6/12, right? The reason we're multiplying it times 1/2 is because we won't pay this, at least in this class, we won't pay this in like month 3 of 12. We're always going to pay it in month 6 of 12, so it's okay for us to reduce this fraction to 1/2. If you're more comfortable and there's nothing wrong with it, you could just as easily put 100,000 times 7% times 6 over 12. It's the same thing. We've just simplified it here to say there's only going to be 2 payments this year of interest, okay? Once we use our ART formula, we'll see that we have interest expense amounting to $3,500, and we're going to reduce our cash by $3,500, okay? So increase in expense, interest expense by $3,500. That reduces net income, which reduces retained earnings. And how did we pay for it? We paid for it with cash. So we'll do this every 6 months. We'll do this on June 30th, and we will do it on December 31st. For the life of the bond. So if it's 5 years, if it's 10 years, however long the life of the bond is, that is how often we will do this. So when we want to retire the bond, this is at the end of the life of the bond. We've already paid the interest because we've been paying it every 6 months. Now we're just going to pay back that principal amount, that $100,000 that we initially borrowed, right? We're just going to reduce our bonds payable by $100,000 because we've paid it. We no longer owe it. And we're going to reduce that asset, cash, because we used cash to pay for it by $100,000. Now the bond is no longer on our books. We are free and clear of that debt. So any questions about that, feel free to contact me. I am happy to answer those questions.